So I'm Nicholas Bornoz of Capital Link, and I would like to welcome you all today to our webinar. Our webinar on a very timely and interesting topic, innovative ways to access the US capital markets. The US capital markets are the market of choice for issuers from all over the world who want to raise capital and they list in the United States. We have with us today, so our webinar today is going to explore a number of alternatives, not just the mainstream IPO, but a number of other innovative ways to access the US capital markets and list in the US. So I'm delighted that we have with us today two experts. First of all, we have Alexander Ibrahim. He is the head of international listings at the New York Stock Exchange. And we have Ted Horton from Seward Kissel. Capital Link is privileged to work with both Seward Kissel and the New York Stock Exchange very closely. And I'm really delighted that we have the opportunity to bring this very thoughtful panel to you today. We are going to start with a brief presentation by Alex on what has happened to the US capital markets year to date. And then we will open it up for discussion with Ted and Alex. And please feel free to submit your questions anytime. And after our roundtable discussion, Alex and Ted will be answering to whatever questions you submit. So Alex and Ted, thank you for being with us. And Alex, the floor is yours.
Thank you. Thanks, Nicholas. Pleasure to be here today. Pleasure to be with Ed in this webinar. I'm going to start with a quick presentation, just giving an overview of what we're seeing in the US capital markets, and then we will go, be having a more dynamic conversation on some of the topics that we'll be covering. Just upload this here. Can you see the deck? Just give me 1 second. Sorry for that. Technology, just give me 1 second, gentlemen. Here we go. Perfect. Well, welcome to the NYSE. So what do we see this year so far is a very dynamic market. When you look at the major indexes that cover the US capital markets, they're all-time high. You see the Dow Jones there, you see the S&P 500 and NASDAQ all perform extremely well, way above previous years. And this is very interesting because we have seen a very strong interest of companies coming to the market. And if you look on a quarterly basis in the top left quadrant, you can see on a quarterly basis the number of companies that have come to the market and also the proceeds. 2020, even we are in the middle of this pandemic, the market has performed extremely well. Since the beginning of 2020, we have seen IPOs getting done, but not only small IPOs in the tech space, but also very large transactions that came to the market. September was an outstanding month for the NYSE, where we had huge transactions, bringing the value of capital raised in the third quarter 2020 at all-time high. This year, as you can see, will be probably one of the best years of the New York Stock Exchange. But when you look and you go a deep dive in what type of transactions we're seeing in the marketplace, and we'll be talking about this later on, about 51% of the deals that have been done in the US capital markets is actually in the SPAC space, followed by healthcare and technology. But this is by the number, but if you look at in proceeds, technology and SPACs are the two largest pockets of types of companies that are actually raising capital. And if you look at pricing, which is always a wonderful measure of how the market is behaving, almost 71% of companies that have raised capital in the US this year are trading above the IPO price. So this is a very good dynamic in the market. At the NYSE, we're expecting the rest of the year to see very, very active. We have a Chinese company pricing tomorrow. a company in the beauty sector that might raise around $500 million. Of course, this is public information. And we have a few specs in the pipeline and potentially another company from China coming to the market in the beginning of December. So very active pipeline for us. And when we look at the first quarter and second quarter, continues to be very exciting. And why those companies are coming to the US capital markets, as I show it to you, very dynamic marketplace. They want to have access to the deepest market in the world, access to liquidity, have the opportunity to broaden their shareholder base, create a currency in the ADR form, dollar denominated, to make acquisition. So a US listing, either you can do through an IPO, direct listing, or a quotation, provide companies with access to this very dynamic marketplace. And when you look at what the NYSE on its own is an extremely international market. We have on average 80%, 82% penetration. If you look at all the non-US companies that are listed on either stock exchange in the US, 82% of them are on the NYSE. And these are companies in the shipping sector, technology sector, biotech, industrial, so a very diversified footprint across the world. And we're also home for very complex transactions, and some of them, some of the companies that are actually participating in this panel could be considered something in the near future. Early this year, we listed Natura, a Brazilian company that actually was listed on the local exchange B3. They acquired Avon on an M&A transaction. And upon the combination of the two companies, they created a new company in the US that is listed with us and also shares listed in the B3. We also listed Spotify. We'll talk more about that later. Was the first ever direct listing in the US capital market. So we had the pleasure of working with Spotify, with the rules, with the SEC to create this mechanism, extremely unique, very innovative, to help companies to list with us using the direct listing process. And very quickly here, Ted talked about different ways of accessing the US capital markets. As you know, there are many forms that companies can choose. Today, we're seeing 4 big initiatives in the US that companies can choose from, especially the ones that are based outside the US. You can do a traditional IPO where there is no public market before, but you have the opportunity to raise capital. There is also now the opportunity of conducting direct listings, and we'll talk much more about that, the process and the mechanics. But these are companies that are actually in the private market that wants to be public traded, and they do not need to raise capital. So companies like Spotify, Asana, Slack, and Palantir chose this process to become publicly traded, and they did not have to go through the IPO process. So at this particular point, there is no capital raise. We can talk about what we have with the SEC to create another mechanism to be able to offer a company to offer shares at the time of the direct listing. This is we can talk about that a little bit later. And SPAC, which has become the #1 provider of new issuances in the US market, is another way. Many companies backed by very well-known executives, they are raising capital in the US market, some of them raising multi-billion dollars to eventually do an M&A transaction where it will help a company in the public market become publicly traded on a US exchange. We have been leading the space. Year to date, 60% of capital raising in the SPAC business has been done on the NYSE, and we continue to grow this franchise, not only listing the SPACs, but also when they find an M&A opportunity, or we call the de-SPAC, those companies remain listed with us. And quotation, we'll talk about this because this is it's a non-US phenomenon. These are companies that actually listed in a local exchange, and they decided to access the US capital markets with an offering or without an offering. and they issue shares, or they just list those shares in the US to increase visibility, to be able to diversify their shareholder base, and to certain companies in certain sectors, even to have an adjustment in valuation. So this is another way for companies to access the US capital markets. Ted?
Wonderful. Thank you very much. Oh, sorry, Alex. So thank you very much for giving us this very detailed introductory presentation. So let's start by asking both of you, I think the most obvious question right now: how has the pandemic crisis affected the US capital markets? I mean, we have seen that the markets have done quite well in terms of performance, but how do you see the capital raising activity and the overall sentiment? So maybe I can start with the Ted, and then we go to Alex, since Alex gave us the.
Yeah, no, I'm happy to start with that. I mean, I think as Alex just showed, and as those numbers have showed, at the high level, the U.S. markets have obviously performed very, very well. And as Alex's slides mentioned, in terms of the numbers of deals and the amount of capital raised, it's been a very good year. It's been near a record year. I think obviously the pandemic has had a different impact on different sectors. So there's obviously been a very different view of what 2020 has been if you're in the tech space, or in particularly in the biotech space, or you are Zoom, than if you are in the hospitality sector or in the cruise ship sector. We work a lot in a space that is in shipping and energy, and the market has been adversely impacted, I think, by the pandemic there. So from their perspective, whether it's a new entrant looking to come in, or whether it's existing companies looking to the market, their stock prices have not been at levels that have encouraged them to come into the markets. But I think, Nicholas, if you're asking, the markets themselves have clearly performed very well. But again, it is very sector specific as to where you're looking at this from.
Yeah. And to complement what Ted said, from an NYSE's perspective, from a capital markets perspective, once, like in the beginning, we started the year very excited about our pipeline opportunities that we saw from around the world, including the US, of course, companies coming to the market, big names. Once the pandemic hit the US markets in early March, mid-March, we honestly thought that the market was going to be completely dead this year. But a few weeks, maybe a month after we were completely, the market, after the volatility up and down in the market, we're starting to see specs coming to the market, which was kind of interesting because we're not expecting that. And little by little, we're starting to see biotech companies, companies that have exposure to COVID, or they are working in related segments of the biotech space. Those companies came to the market, and they're all pricing very well. And right after that, we're starting to see companies in the tech space that actually were benefiting for working from home, food delivery, things that we are not expecting in a pre-COVID environment. And those companies came to the market, and they were priced very well received. But what was interesting from a non-US perspective, that we're starting to see the same model outside the US. And companies, starting with China, companies coming to the market, raising capital. We saw companies from Europe, from Latin America, from Canada. And if you look at the type of companies that came, the sector, the majority of them were, of course, let's use SPAC as a sector, but it's not a sector, it's a product, followed by biotech and technology. And then consumer tech, more towards the third quarter. And this was not only a US phenomenon, but actually a global phenomenon. And that's what we expect to see in the beginning, in the first quarter 2021 and the second quarter 2021, because we're pitching those companies right now.
Very interesting and very optimistic.
Yes.
Absolutely. So, by the way, going into the next question, as I mentioned in the opening statement, the US has been the destination of choice for most, for all the companies that aspire to raise capital. The US, I think, is the deepest pool of capital around the world. So can you tell us why would somebody choose, if I'm an issuer, a private or a public issuer who wants to do a listing, why would I come to the US as opposed to going to other regional markets, London, Oslo, Hong Kong, and so on? So what makes the US and of course NYSE the destination of choice? So maybe I can start with Ted, and then I go to Alex. And
yeah, absolutely.
Well, I think the short answer is it's still where the capital is. I mean, I think that the U.S. markets, as we are saying, are still the deepest pool of capital, and it's where the capital is, and it's where the liquidity is, which of course is what is the end game for any company that's looking to come in and to list in the markets. And I think that I think that there's obviously there's the dominance maybe of the U.S. The questions start to come up of where Asia is rising, but I think it's not a surprise to say, or it's not controversial for me to say, is that the recent example of maybe the anti-IPO shows is that there's still how do I put it? I mean, the U.S. regulatory market is still the gold standard, I think, in international standards, and I think that still has value to investors, and that of course translates into being attractive to issuers and aspiring issuers. At a very high level, I think that's really what drives that.
Thank you, Alex.
Yeah, I mean, as Ted mentioned, the U.S. capital markets is the deepest market in the world. And if you look at the type of investors that actually operate in the U.S. capital markets, they tend to be extremely diversified. And you even have access, if you're listed here, to the retail market, which is very vibrant in the U.S., as you know. Especially this year, we have seen a lot of trading, retail trading in the U.S. exchange. So the market is very deep, very liquid. We have diversification, which is very important. So for a company that is listed in the local market, I mean, maybe that's plenty. They don't need to be in the US market, but there are certain sectors of the economy having a dual listing, or if they are planning to do an IPO, conduct the IPO solely in the US market or in conjunction to both markets, could be an alternative, because they would be able to tap into this pool of liquidity that otherwise, by just being listed locally, they would have not problems, will be more complicated for them to access this liquidity. Let me just give an example. We're doing analysis for a Brazilian company in the financial sector, and the peers are listed with us on the NYSE. If you look at the shareholder base of this Brazilian financial service company that is just listed on the B3 in Sao Paulo, and you compare to their peers in the US, the shareholder composition is completely different. The local company has a huge participation of local funds, which is very good. Brazil is a very deep market, a little bit of retail. But when you look at their peers, they do have the US investor that actually looking at the financial sector. They have the Brazilian dedicated funds and the emerging market dedicated funds that trade through the NYSE. So by being cross-listed, you really actually complemented this liquidity that you would have only in the local market. And remember, Ted, I think you know this, a lot of the funds, many of the funds that are in the US, they're looking for opportunities outside the US. They cannot trade for many different reasons in local exchange. It could be maybe a technical issue that they cannot use foreign currency when they're using the models, or there are some restrictions of their bylaw, and even lack of understanding how to trade in a local exchange, given the barriers, the regulatory framework in certain countries. So having ADRs here, either on OTC level 1, a lot of companies have done that. The shipping space is a great example, or even companies from Europe, Canada, they have an opportunity to tap into this market. By being listed on the NYSE, registered with the SEC, the opportunities are even wider because more funds will be able to trade this.
Alex,
sorry, go ahead, Ted.
I was just going to add one point. I think it's important to note too. I mean, I think we're talking today sort of these alternative opportunities in the U.S. and I think how the U.S. markets, both the regulatory side and the SEC, and certainly the NYSE and the exchanges are trying to make it easier to come in. But I do think it's worth noting is that the other markets, whether they be foreign markets or whether they be 144A markets in the US, let's say, other than the public listings, I think they can be very complementary to sort of the end goal, let's say, which is to have a listing on the New York Stock Exchange or on a US exchange. And just an example of that is, again, in the shipping space is an area where we spend a lot of time in. A well-worn model there is to go out and to do capital raises in foreign markets. Oslo is one market that's particularly friendly to, I think, to shipping and to energy. It can be done very quickly. A lot of the capital that still goes there is the US, but that very much is viewed as, or has been viewed traditionally as a stepping stone to allow companies to raise capital initially and quickly, and then transition back into the US, whether it's through a quotation listing, whether it's through a traditional IPO, any number of ways to come in. So I think my point being in this conversation is that the other markets, let's say, can still be very complementary to the main US listings and traditional capital raising opportunities that are here.
Yeah, no, I agree with Ted 100% because local companies technically should be listed in local markets. The US market is really to complement this liquidity and create some adjustments, could be in valuation, maybe refine the shareholder base to mirror a little bit more of their US traded peers. So yes, I agree. And the case that I mentioned, the financial sector in Brazil, it is the perfect example because if you're just listed locally, plenty of liquidity in the local market, very strong shareholder base. The US capital markets will add this layer that they don't have access by just being listed locally.
So you really brought me now to the next set of questions. I had in mind to ask you to take us through the various options, because we talked about these innovative ways, alternative ways to access the US capital market. So let's start with the first one. I'd like to take us through, to have your brain power take us through the various alternatives. I'm a private company and I'd like to get listed in the US for the first time. I'm already a publicly listed company in another exchange, and I would like to list in the US, raising capital or not raising capital, and then talk about SPACs. But since our discussion was at the point of the dual market complementarity, let's start with that. So I'm a company that is listed overseas in the local exchange, and I would like to tap the US capital markets with or without capital raising. Can you take us through the process and exactly talk about the benefits and how to do it? So maybe
have you start.
Yeah, maybe
start on that one.
Alex, the floor is yours.
Oh, I thought Ted was gonna kick off.
I can go ahead, Alex. Go ahead.
Yeah. So maybe, yeah. Okay. So this is from really a capital markets point of view. Ted will highlight more the legal implications. But if the company is publicly traded in the local market and they want to list in the US, they have two options. They can raise capital and not raise capital. And the two formats kind of go hand in hand. So if you want to be listed in the US market on a regulated exchange, either on NYSE or on our competitor, you have to be registered with the SEC. You have to comply with Sarbanes-Oxley. You have to follow the disclosure requirements from the NYSE. It is, a little bit, the requirements are a little bit higher. If you decide to do this, you can just do a quotation without capital raising, or you can do what we call a follow-on in the US, in conjunction with the listing. So those two options are available. But there are times the companies don't want to do that because they want to take the first step. They want to, let me test the waters. Let me see how the US market will look at my company. So they can opt for what's called an ADR level 1 or a OTC listings, which is, for some companies, that is the right choice, makes sense for them. And eventually they can upgrade to a level 2. So that is the capital markets overview. But I think that maybe you want to talk a little bit more about the regulatory requirements, right?
Sure. I mean, the process and I mean, I don't know that I'll sort of limit this to coming in and doing a listing. The ADRs are obviously going to be something that's been out there for some time and a slightly separate opportunity. But I think, Nicholas, to your question is it obviously, you obviously have to depend. If a client comes and is having this conversation is what is the best strategy for me to get to the US? The question, of course, is it capital? Are they looking to get capital or are they looking to get the listing, have the liquidity for the shares, have the exposure to the US and the US investors, as Alex mentioned, can be important to sort of expand that investor base. And there are also some other regulatory issues for future capital raisings that are advantageous for companies to be able to come into the US and be what we call a seasoned issuer. So basically is to be registered with the US, obtain a listing, and then that means that in the future, typically after 12 months, then the capital raising process with the SEC can be more streamlined and can be done sort of behind the scenes. Let's say the use of shelf registration statements is what I'm getting at. So that's one of, I think, the drivers for people to come in, get the listing here without the immediate need for capital. As Alex said, the process for coming in is still, in some respects, in terms of timing, it is similar to raising capital in that it is still an SEC registration process. Although I think that it is a slightly lighter process than it would be to do a traditional IPO. And I think the other issue that, of course, is a factor is meeting the listing qualifications if the goal is to get a listing on the NYSE or the other exchange. And I think that one of the issues is that from an issuer's perspective, there's a couple of different categories. There's categories of companies that what I think has been referred to as in the industry as sort of unicorns, very well capitalized companies, probably have a relatively large shareholder base because of their existing operations, employees owning shares, and previous financing rounds. And there are other companies that are going to come in that don't have that. And those other companies that come in, they may or may not meet those listing standards. I think that there are several different avenues, of course, on the New York Stock Exchange as to qualify for that over the years have become, I think, more accommodating to some smaller issues. There are also issues that relate to how many shareholders they have meeting what's called the distribution requirements. So I think that by and large, the view is that the quotation listing or the listing without capital raising is something that is becoming more and more available to a wider variety of issuers. It's still something that needs to be looked at and to determine whether you will qualify. Not every company will be able to do that. But I can give some examples of some very small companies, again, in the space that I spend a lot of time in, have done, I guess, Alex, what you would refer to as not the quotation listing, but coming in, not doing a capital raise and finding a listing on an exchange. Some very, very small companies have been able to do that. But it does require some creativity and some efforts on the part of the company to meet those initial listing standards.
So what I wanted to ask you to make it even simpler and more obvious, if I'm a listed company, I can tap the US capital markets without raising capital, and that is a quotation listing, or I can tap the US capital markets with capital raising at that time. So my question is the following. If I go for a quotation listing, which means I do not raise capital, then I understand it's more of a legal process. I do not need to involve an investment banker because there is no market outreach to raise capital at that point. So my question is, number one, is the process from the regulatory standpoint simpler? And number two, I think that creates the basis for a company that gets a quotation listing later on to raise capital when and as they see fit. Am I right?
Yeah.
I think that's generally correct. Yeah, and the later capital, again, is, as I said before, there are significant advantages to being what we refer to as a seasoned issuer, someone who has been a reporting company in the U.S. For some period of time, to be able to go raise that capital in the future.
But yeah, what I'm trying to ask is, sorry, go ahead.
No, it's breaking up. I'll comment after you. Go ahead, Nicholas.
The question that I wanted to ask is, if I go for a quotation listing, no capital raising, versus do a listing with capital raising, is there a difference in the regulatory process or no?
Well, Alex, maybe I'll let
from the end
to you, because that's a new opportunity. I know that you want to talk about.
Let me just make a comment from, you mentioned something interesting before, and then I answer your question. We have seen many companies that are based outside the US that actually use the quotation system to access liquidity in the US without capital raising. They did that without bankers. They did with their own, with the lawyers and the advisors to do this process. And those companies that have been extremely successful. And they later on, as Ted mentioned, they decided to raise capital. The company was already registered with the SEC, so the process is much easier. But there is something very important. The company is already traded in the US. The shares is priced in US dollars. The company has already a strong US shareholder base. So it's much easier to market the deal once you're listed in the US. And I have great examples that companies actually have done that, because they thought by the time of the quotation, I do not want to raise capital. I want to build this infrastructure around me in the US before I tap to the market. So it is actually the path that a lot of companies do. They do the quotation, later on, they can raise capital. To answer your question about requirements, for a foreign private issuer, the NYSE's corporate governance requirements are actually more flexible than if you were a domestic issuer. FPIs, foreign private issuers, they could rely on home country practices. And whatever you do in your home country, the NYSE will accept that, as long as you disclose the difference between what the NYSE requires for domestic issuers versus what you are required in your home country. So it's a disclosure. You put on your website, and also you add in your Form 20F, the annual report, or the 40F in case you're a Canadian company, with the SEC on an annual basis. The NYSE also requires the companies to have semi-annual shareholder investor meeting. Report on a semi-annual basis. In the past, we would ask companies to follow home country, but now we are requesting that companies at least twice a year they report their earnings. But if in the local market you have to do on a quarterly basis, the NYSE will expect you to do the same. But the requirement is twice a year. There is a component that comes from Sarbanes-Oxley, which is the audit committee requirements. The NYSE will ask that a company listed with us, doesn't matter if it's domestic or a foreign private issuer, they must have an independent audit committee in place at the time of listing. So the process for us, if you're a non-US company, a foreign private issuer, is a little bit easier if you were a domestic issuer. And the NYSE also accepts IFRS. You don't have to convert your accounting into US GAAP. And you don't have to comply with all those requirements that the NYSE asks for domestic issuers in terms of corporate governance.
Yeah, and I would just add, I mean, I agree with all of that. Of course, I think on the regulatory side, what we see with our clients, and we do have a number of foreign private issuer clients, I think on the governance side, the most of the clients and it's based on the expectations of investors today will comply substantially with the governance standards that are going to be applicable to U.S. domestic companies. I agree with Alex. I think that on the disclosure opportunities or the disclosure requirements, there are some differences there, particularly with proxy disclosures. Section 16, which is a whole different issue, but it's reporting in real-time insider trading issues. There are some significant differences that are very advantageous to the foreign private issuers, and that it is common for them to take advantage of those differences.
Well, building on what you both said, what I take away, I mean, looking at it from a commercial point of view, we are talking to a number of companies that are eyeing the U.S. capital markets, and some of them are concerned about raising capital because the valuations may not be the right ones at a particular moment in time. So I think the quotation listing, as you both pointed out, allows the company to become part of the U.S. capital markets, position themselves on the runway, and then take off with the capital raising whenever they see fit in the future. And clearly, I think from my experience, when you are part of the US capital markets, you open yourself to a very large investor pool. You get research coverage from the US based houses. So you really are playing in a very different field. And closing, for this particular question, I take away that foreign issuers, at least at the beginning, have lighter, I would say, practice to conform with in terms of corporate governance and disclosure, even though clearly the market expects them to have very high standards anyway. So did I sum it properly, or?
I think from my perspective, that's a very good summary. And I think the only other thing I think I would add is that on the listing, in the absence of capital, is that publicly traded stock is a currency. It can be a currency. And I think that's also an attraction for issuers to be able to have that as another option to be able to use, whether it's for M&A transactions, asset acquisitions. But that liquidity that a listing gives you is obviously a necessary requirement from that. And it's another one of the advantages.
Exactly. Okay.
And also, a lot of companies are global companies. They have employees in the US. By having shares traded in the US, you can use the shares in ADR form, ordinary shares, as part of the compensation plan, stock option plan. So that's very attractive to global companies which have a presence in the US in order to retain employees and even attract talent. So companies do that from different reasons, not only for liquidity, but Ted mentioned a great point, the M&A route, super important to having the shares here, dollar-denominated securities.
So let's go now to another topic, and I think this has the NYSE brand in terms of pioneering this concept. I'm a private company. I'm not listed anywhere, so there is a way for me to become public without going through the traditional IPO process. So let's start with Alex, since I think the NYSE pioneered this concept, and then have Ted join in.
So yeah, and Nicholas, for a private company, there are different routes to access the U.S. capital markets. The NYSE, we've been very creative, and actually we're disrupting the market because we are offering different opportunities for our issuers. And I think what is making the NYSE so relevant now in this discussion is the fact that we built this product called direct listing, and it became available 2 years ago when we listed Spotify in the US capital markets. It was a huge transaction. It took us a long time to go through the SEC review process. I was personally involved in throughout the process. And it was very dynamic and interesting because Spotify honestly did not want to raise capital. They have plenty of capital, but they want to be a publicly traded company because, very high level, there are way more nuance to this, but high level, they had plenty of employees. that held shares in the company. They receive it as some type of stock compensation, year bonus. Small investors that enter Spotify in a very early stage of the company, and they want the liquidity. So how do you fix that? So direct listing was the solution. And we were able to do this with the SEC. Spotify, as I said, was the first company to do it. And we create this mechanism where a privately held company that met the standards that the SEC approved of at least $250 million of free float, like all those investors together with a valuation by either a private market trading on Spotify that occurred before. Private market trading is not in the public market. It is really done within an investment bank infrastructure of high net worth individuals where there is a price over there. So you can use, you could use, in the case of Spotify, there are quite a few markets trading Spotify privately. So you're able to get that price, look at the number of potential shareholders that own those shares, and figure out that it was more than $250 million, which was the minimum requirement to be able to conduct this transaction as a direct listing. Spotify met the standards. So we had a price, which, if I remember correctly, was $132 was the reference price. And that's what we did. We posted at the opening. You need to designate a market maker at the NYSE to conduct this. This is not an electronic process because there is no one there to help with liquidity. There is no underwriter. There is no stabilization agent. This is organic. And the market will dictate if that is the correct price and the demand for those shares. So the moment that you post the price, investors from Spotify, they'll be able to sell them. And any investor could start buying those shares. And the beauty of the NYSE in this mechanism, that is our market maker looking at supply and demand, determining the correct price to open the stock. And for Spotify case, took 4 hours and a half, took a long time, but you're able to find the correct price where investors could participate on the trading of Spotify. Why it's relevant? Well, it is really an organic process where you don't have the interference on anyone in the pricing of the stock and the liquidity. So you don't have the bankers, selling to a certain group of investors and to a certain degree helping, figuring out the price that sometimes, we saw this year, certain companies, they price at a certain level. When they open in the public market, there was a huge jump. Direct listing correct for that because you don't have, the market will actually dictate the price. So Spotify, first day of listing, was the 5th largest auction ever on the NYSE in terms of liquidity. So very successful transaction. And we're starting to see other companies looking into this.
So Ted, amplifying what Alex said, the direct listing is, of course, not only for companies of the size of Spotify, but I guess it's available both for domestic, US, and foreign companies. And as I understand, because of the fact that for this mode, you do not raise capital, it's more of a legal process. Am I right?
Well, it is. Look, I think there's some, and I think a number of, when we have these conversations with our clients initially, I just clarify, I mean, and Alex and the New York Stock Exchange have very clearly defined what a direct listing is. I think there's a perception sort of in the market that a direct listing refers to something that is obtaining a listing without getting capital. And so just to sort of clarify this, that is the distinction, Nicholas, what you've said, which is that a direct listing is a brand new. A quotation listing, as we're referring it to here, is an issue where there is some other trading market. And I think that, Alex, as you mentioned, the pricing is really one of the main issues of where you're going out, where you don't have a book building process and investors coming in to set that price. Where you open that trading is always one of the difficult things to do. And I think that's something that the quotation side, and I'm sorry, Nicholas, I'm deviating a little bit. On the quotation side, it doesn't necessarily have to be another listing on regulated exchange like the LSE, but there needs to be some other market to establish the price to come in. Coming back though to your direct question, yes, I mean the answer is that the direct listing, same as the quotation, it is still a legal process. The compliance and meeting the requirements of the exchange, of course, is paramount. But the SEC process, there is still a registration process to come in and register with the SEC. It's slightly different. You're doing an offering versus you're actually registering existing shares that are already in existence as they selling holders. But from a timing perspective and from a level of disclosure perspective, it is going to be similar to the issuers that are looking to do that. And I think that the point that I would make, I think that as far as the size of the companies coming in, I mean, look, the direct listing route is obviously not going to work for all companies. I mean, much smaller companies are not going to be able to initially satisfy that. But I think that's just, I don't think that was an oversight. I think that that's just what that is. There are certain companies that are going to be suitable to sort of start and have this initial pricing and have the liquidity among holders, because on day one, there are no other holders. Very small or startup companies that don't have that probably are not, well, they're definitely not going to be able to meet those qualifications. But they probably wouldn't be suitable for that trading on day one anyways, I think. But I do think, again, those companies can come in and do the quotation listings. And as I alluded to before, there are some very small companies that have done that, who have been able to establish the existing pricing basically through private market or OTC trading platforms in order to satisfy the exchange requirements, is to set that pricing on day one.
So, Alex, if I understand correctly, one of the hurdles for a private company that is not listed anywhere to go for a direct listing is they have to have already the minimum number of shareholders that would allow them to qualify once they list. And what is that number, 400?
Yes, it's absolutely right. I failed not to mention that in my remarks. Yes, you have to have at least 400 round lot holders that if you multiply the holdings by the share price, that is either the price that is traded in a private market, not in a public market, private market, or in case the company does not have a private market, which could happen, a valuation analysis conducted by a third party that will do two actually valuation analysis that will determine the potential price for those shares, so that we can multiply the number of shareholders by this, let's use potential price, and that value has to be above $250 million. But what's going to happen is this is a reference price. That is what we believe that the company should start the process, right? What's going to happen once you post on the trading floor, supply and demand will dictate the correct price. And what we have seen so far, the reference price is very aligned of how the market reacts to the company. Spotify, the delta was not huge. The reference price, it was 132. The company opens at 145. So it was very well aligned to how it was traded in the private markets, how it was, we thought was the correct reference price. Of course, work with the company, with the regulators to be able to post the price as the reference price to start the bidding process, the auction process. And I had to make a very good point. Direct listing is not for everyone. So far, we have done 4, Spotify, Slack, Palantir, and Asana. I think Palantir and Spotify are very well-known brands. Slack, not that much. And Asana, it is not as well known in the market. But having said that, we're starting to engage with companies that are in the tech, consumer tech, that they see this as an opportunity. So we might see not only big brands like Palantir and Spotify, but companies a little bit smaller with less brand recognition coming through this path. And we might see non-US companies also considering this. But I think from the non-US side, it has to be a company with a bigger presence in the local market, that they probably have enough employees, early stage investors, that they can use them eventually to create ADRs to be able to start trading in the US through the same process that Spotify and others did.
So Ted, if I look at the alternatives, traditional IPO, we know the process from a legal perspective. Dual listing or quotation listing, again, I'm already public, so I have already an accumulated infrastructure of regulatory compliance and disclosure. And then the direct listing, where I'm completely private and I go for the first time to get listed. Does the process, is the process more cumbersome for a direct listing from a regulatory and disclosure viewpoint, because I have to prepare all those documents? Whereas in the dual listing, I already have them because I'm on an exchange already.
Well, it's obviously going to depend on what other exchange that you're on. I'll just use, I'll use, for example, London Stock Exchange is something that I just picked that out of the air. It's going to depend on how developed in terms of governance, in terms of corporate structure, honestly, even just tax efficiency. So I don't know, that's a hard question to ask. Every company that's looking to come into the US market has to step back and see where they are and are they ready to be public, whether or not there's a capital raise there or not. I think that the answer is that the level of disclosure and the registration process with the SEC is going to, again, using the word substantially similar, there's going to be some differences. It may even be on a different form, but the level of disclosure is going to be somewhat consistent for each of those three options. And the ongoing reporting requirements for a company once it is listed are going to be the same regardless of how they came to be listed and be reported. So I think it depends. I think to your point is a company that has been through the process on a regulated exchange certainly is going to have an advantage in that they are have been a public company, have the reporting procedures largely in place, presumably are going to have financials that are largely in place. So it is going to be an easier process for them. But it is still, the level of disclosures in the US markets are not going to be different depending on which of those three routes they choose.
It's interesting, by the way, that of course, even though size is an issue, we've seen that, a few examples of even smaller companies doing direct listings. But let me go to Alex. Alex, you pioneered the concept of direct listing, which, at the beginning was without capital raising. But I understand you're also working now on an option to have a direct listing with capital raising. Can you elaborate?
Correct. And we are working with the SEC to finalize, hopefully, an approval for this new rule. It is the possibility of a company to raise capital at the time of listing. It will be a primary offering that the company will be able to do at the same time that they start to trade on the NYSE. We still don't have the green light from the SEC, so I cannot comment too much on it, but it's going to be the next step, what we call direct listing 2.0, because we'll be able to offer the opportunity for the company to conduct an offering in conjunction with the direct listing. So I think this will allow smaller companies, potentially non-US companies, to access the US capital markets using this version of the direct listing. And we came up with this because there was the feedback that we heard from issuers as we were discussing direct listing with bankers, with lawyers, with their input to build the 2.0 version of the direct listing. So stay tuned. As soon as we get the approval, I hope Nicholas invite us again, myself and Ted, to talk about it.
Absolutely. We're going to have another webinar on that, and so
Yes.
we are waiting. So now let me go to the next topic, SPACs. We have seen a significant increase in the activity of SPACs as a means of getting a U.S. listing. So can you tell us a little bit about how this works? What is the process? Maybe I can start with Ted and then go to Alex.
Sure. No, I'm happy to. I think that first slide you had, Alex, showed that SPACs of what they're 50% of the activity during 20. So a SPAC essentially, which SPAC is an acronym for Special Purpose Acquisition Company or Corporation. The process of a SPAC in its shortest form is it is a company that goes out and raises capital in a public offering and lists on the New York Stock Exchange or another exchange at the time of the IPO. That capital is put into a trust account that is set aside from other certain operating expenses. It's basically set aside. It can only be used in connection with an acquisition or a merger of an operating company, usually a private operating company, at some point in the future. And the typical lifespan as a SPAC is that they will do the IPO, and then they will go out and they will commence the research and the analysis and identify a target operating company. And they usually have between 18 and 24 months to do that. And once that operating target is identified and a merger agreement is negotiated, then the transaction is announced. And in a typical structure, that transaction is presented to the holders of the SPAC, and they either approve it or they can reject it, but they will typically approve it. And one of the interesting components of the SPACs, and the SPACs have evolved over the years, but the current iteration of SPACs is a bifurcated vote. So there is an opportunity to approve or disapprove the merger transaction. There is also an opportunity for investors to redeem from the trust account that I referred to the money that was put into the SPAC, that was put into the IPO. And that vote, as long as the capital remains and the approval for the merger comes, the merger will go forward. May or may not be additional share issuances, and the investors in the SPAC will then become investors in an operating company that will remain a publicly listed company and go forward as a business. I'll stop there, but that is the main structure of a SPAC.
So amplifying on that, we actually have a question that came from Harris Antonio on this. So Alex, repeating maybe some of the things that Ted mentioned, can you take us through the de-SPACing process? Because raising the capital for the SPAC is step number one. Step number two is announcing the transaction. And step number three is getting the shareholder vote to consummate the transaction, in which case the SPAC, that is a financial company, becomes an operating company. So Harris was asking if you can take us through the de-SPACing process. Is there a shareholder rotation? I mean, that's more of a market practice question rather than a regulatory, but I'm sure you know.
Yeah, I mean, I think Ted gave a very good explanation, and you also summarized really well the process. At the exchange, we're going to look at this as any other listing in terms of coming to the public market. We will work very closely with their advisors, the lawyers, to make sure it's a smooth transaction. We'll set up a date to start trading upon the mergers, the SPAC of the mergers approved. So work very closely with them to set up the date, and the company will start to trade. In terms of rotation, I don't have data, but what I have heard is that, a lot of those investors eventually will want to get out, and they will wait for the company to be publicly traded to have an adjustment on the share price, and eventually they'll go out and others will come in. So I think it will be it's just part of the process of becoming a publicly traded company. But what's important in this whole, like even before the SPAC and the M&A, what we have heard from sponsors looking for potential acquisition is that when they're looking for companies, they are looking for companies that actually they have been doing the exercise of eventually either going through the IPO route or potential SPAC. So those companies are very advanced in the process of going public. So they have a board, they have all the internal controls in place, they have some governance in place. So that facilitates the process. And another point that I just to add that is that this phenomenon is no longer a US phenomenon. We listed a SPAC from Brazil about 2 months ago, very well received in the market. We listed 2 from Hong Kong. We listed a few from China, and we are working at this point with 5 new SPACs from Southeast Asia and 1 looking at Latin America. So we've been seeing more and more this product from a sponsor level from coming out now from outside the US. And if you look at the sponsors that are behind those SPACs, very well-known names in the market. So that helps tremendously in the marketing of the SPAC and also for the potential business combination.
Alex, let me understand. When you say non-US SPACs, you mean SPACs that are listed some other place and they come here, or
No,
the sponsors are non-US?
Yeah, no, that's very good. When I mention non-US SPACs, these are SPACs that the sponsors are based outside the US, can be a big investor in Singapore or Hong Kong. They come into the US as a foreign private issuer. They file as an FPI, and they are looking for potential business combination in the US. They could be looking for assets in the US, but also in local markets.
Okay, perfect. So the sponsor is non-US.
Non-US.
They list in the US and they're looking for opportunities in the US and globally.
Yeah, exactly. And if you look at the last, especially the larger SPACs that we have done on the NYSE, if you look at what they are looking for, it's no longer US. Well, they are actually very clear. We're going to be looking at consumer companies around the world or technology companies in Southeast Asia. I'm just, give an example. So yeah, it's becoming more and more international.
Yeah. Well, adding a few, we've been involved ourselves, with a number of SPACs over the years, and trying to reply to Harris's question. I think you do have shareholder rotation in the sense that once you announce a transaction, then you know what sector you will be operating in once the transaction is consummated. So it is very normal for fundamental investors who are currently invested in that sector, but in other peer companies, to take a look at the transaction and possibly come in before the vote to take advantage of any valuation arbitrage opportunity. So I think that's one of the beauties of the SPAC, that it provides a pool of capital. You find an operating company to consummate with, and then you attract new investor base in.
Yeah.
I think that's one of the points I make, Nicholas. I think that's right. You're absolutely right. Is that the transaction is announced, and so that the target is identified, and there will be people that coming in there. I think, as Alex just mentioned, most of the SPACs, I think, out there are probably disclosed on day one as being a sector focus. In theory, they could go in for anything, but most will be relatively specific on what it is that they're looking at. And it will reflect the expertise and the background of the sponsors in a lot of cases. The other point that I would just make is these SPACs, because of the redemption rights that I was just discussing, these SPACs trade in a very narrow band up through that shareholder vote, because the value that they basically are trading what the redemption value is. It's almost it's a fixed income instrument. The other just point I think that's relevant to that in investors coming in and coming out. We're asking about coming in, but there is redemptions. There are very often redemptions that are people are looking to take the money out. There's another component of SPACs, which is our certainly warrant coverage, which also affects the trading to some extent. But the point that I would make is that a lot of these SPACs, particularly recently, have been accompanied by additional capital raises just before the merger in terms of PIPE transactions. And mostly institutional investors are coming into that, but a lot of these SPACs are raising relatively large amounts in terms of comparison to what their initial IPO proceeds were even in that pipe round in order to facilitate the merger that they have negotiated.
By the way, we have exceeded the hour, so I'll try to be quick so we don't go, but it's been a very interesting discussion. One of the questions we have that came through, it says from Katerina Stathopoulou, it says, I would like a clarification on the quotation listing. If I'm listed on OTC outside the US, do I need to have 400 shareholders in order to do a quotation listing? I don't know who would like to.
I can answer
the same answer.
from the NYSE's perspective, but maybe Ted, I mean.
Yes, I mean, the what we call the distribution requirements, the short answer to that is yes. There are some, how exactly those are calculated is something that to look at, but the short answer is yes. Yeah. It is a requirement to have that.
Correct. Yeah, from the NYSE's perspective, absolutely, 400 round lot holders. And
going to another question quickly.
North American investors.
Sorry.
No, sorry.
So, Alex, if I may ask you, NASDAQ recently said it will strengthen its listing standards for Chinese companies. Do you plan to do the same at the NYSE?
No, actually, we were very excited to hear that from our competitor, because we do have the highest standards of corporate governance in the world, and see other exchange, in this case NASDAQ and others, actually looking at us and adjusting some of their requirements to be a little bit closer to our standards, I think is positive. But we do not have any intention to change our standards. We believe what we have, it's the best in the world, and companies look at the exchange as the most prestigious, most liquid, and with the highest standards.
I didn't mean it as a competitive positioning question. I wanted to find out if the listing standards are kind of uniform in a way. Every exchange has their own. How does it work?
When you look NYSE versus NASDAQ, for domestic issuers, we have a few things that we require companies to do that NASDAQ does not. One example is to have an internal audit function, which is required by domestic issuers. But when you look at non-US issuers, as I said earlier, we're relying on home country practices, but we do require companies to report on a semi-annual basis. But we do not require non-US companies to have an internal audit function.
I see. Okay. So then as a closing question, I would like to ask both of you, what do you see for the rest of, we are practically at the end of 2020. What do you see for the market ahead next year in terms of activity, sectors, more international interest, more US activity? I know you don't have a crystal ball, but as pretending that we do, what do you see?
Should I go first? I'm happy to start. In one word, I think optimistic. I think as Alex started, I think the resilience of the markets through 2020 and the pandemic has been encouraging, considering I think what people may have feared back in March. I think that there's been a lot of uncertainty, both in terms, I think, of this election, has, I think, had somewhat of maybe not a chilling effect, but a sort of a delaying effect. Some people see how that has gone through, and I think by and large, that is now behind us. There is obviously a lot of optimism, I think, in the markets that we've seen just in terms of COVID. I think it's, it's somewhat to me is surprising. I think there's still a long way to go, obviously, on this, but the news coming out of the pharmaceutical space is promising. So I think that it's going to be a hard first half of 21 still, there's no doubt. But I think that I'm very optimistic is that the fundamentals are strong. I think it will be sector specific as to where it goes. But I think that 21 will continue to be a good year for these markets. I really do.
Yeah, I agree 100% with Ted. For more like a, if you look more specific in sectors, regions, US market, we'll see a lot of technology companies coming to the market, big names that that you interact with on a daily basis. We'll see those transactions coming to the market. And they will come very quickly because they want to make sure they are in the public domain to be able to, many reasons. We'll see direct listings. That will be another option the company will be looking at. And from when you look at sectors, it will be tech, tech, tech. I think tech, consumer tech, a lot of fintech, tech-related companies that would be the theme for the first half of 2020. We'll see biotech companies just because of the COVID situation and just the maturity of the biotech space. So we're going to see more companies tap into the market to be able to help them grow and develop new products, etc. In terms of regions, China will continue to provide, be our second market, US first, second market China. But I'm very bullish on Israel, especially in the tech space. To a certain degree, Russia, and in Latin America would be Brazil.
Wonderful. I'd like to thank you both. It has been,
Yep.
we have this now for an hour and a quarter, indicative of the depth of the discussion, the quality and the interest. Thank you both very much. And Alex, I look forward and to the next one.
Thank you.
Have a great rest of the day, and thank you everybody for being with us. Thank you.
Right. Thank you, Nicholas. Bye-bye.